So below are the statement of financial position of Dixon as at 31 March 2008 and 31 March 2007, together with the statement of profit or loss and other comprehensive income for the year ended 31 March 2008. Non-current assets, property, plant and equipment, development expenditure, current assets, inventories, trade receivables, trade investment, cash, equity, share capital, share premium, revaluation surplus, retained earnings, non-current liabilities, 6% debentures, finance lease liabilities, deferred tax, current liabilities are trade payables, finance lease obligations, finance lease liabilities, current tax, debenture interest, bank overdraft, total equity and liabilities, statement of profit or loss and other comprehensive income. Then we have revenue, cost of sales, gross profit, other expenses, finance costs, profit before tax, income tax, profit for the year, other comprehensive income, gain on revaluation of property, plant and equipment, total comprehensive income for the year. Now, so you can see that I explained yesterday that we are given the closing balance in 2007 and the closing balance in 2008. That you should take note that the closing balance in 2007 will be the opening balance in 2008, right? So take note of that. So, and always the statement of profit or loss and other comprehensive income and all are always for the year. So these are the performances of 2008. 2008. So notes. During 2008, amortization of 60,000 naira was charged on development projects. During 2008, items of property, plant and equipment with a carrying amount of 103,000 naira were sold for 110,000 naira. So let me just explain one by one. Okay. So I have shared the format with you. So you should be able to have you should be able to check it. So if you can follow it, can follow us through the format now. So all right. During 2008, amortization of 60,000 naira was charged on development projects. Now, before I move forward, amortization, please, which of the section in our statement of cash flows it falls under?
It falls under operating activities.
Under operating activities. Thank you very much. So, and you can see that means it will fall under non-cash items, right? So, fall under operating activities. Thank you for that. They now said, during 2008, items of property, plant, and equipment with a carrying amount of 103,000 naira were sold for 110,000 naira. That property, plant, and equipment, you will agree with me that it falls under investing activities. And we've seen proceeds from the sales of property, plant, and equipment, or disposal of property, plant, and equipment. Kindly note that the disposal of 103,000 naira has nothing to do with cash. The only amount that we collected from the sales of that value was 110,000 naira, which has to do with what? Cash or bank proceeds. All right. And that is the amount that we are going to recognize under investing activities. However, the current amount was 103,000 naira, but we sold it for 110,000 naira. Then we have what? Profit on disposal. That profit on disposal will also form part of what? Non-cash item. Do you understand? Because the profit would have been recognized as part of the profit that occurred in 2008. Do you understand that? Then we have depreciation charged in the year on property, plant, and equipment, total how much? 57,000 naira. So which means that 57,000 naira is what? Is going to operating activities. All right. So then we have this Dixon now purchased 56,000 naira, 56,000 naira of property, plant, and equipment. Property, plant, and equipment by means of what? Finance leases, payments being made in arrears on the last day of each accounting period. All right, so we have acquisition on finance leases. So we are going to see how we are going to treat that. So number 3, the current asset investments are government bonds, and management has decided to class them as cash equivalent. So very well. So which means we have what? Cash and cash equivalent. You are going to see how we are going to treat we are going to treat that. So the new debentures were issued on 1st of April 2007. Finance cost includes debenture interest and finance lease finance charges only. So which means we have new debentures, which was issued in 1st of April, then it's quite all right. So number 5, during the year, Dixon made 1 for 8 bonus issue. So we have capitalization of what? Of retained earnings, which was the reason why that retained earnings declined in 2000 from 2007 to 2008. All right, so we're going to see the capitalization. So A, prepare a statement of cash flows for Dixon in accordance with IAS 7 using the indirect method. Prepare additional net cash flow, cash from operating activities using the direct method. That's fine. So we are going to, let's start from the treatment of SaaS cash flows from indirect method. All right, so let's start from here. So before, okay. Uh, Dixon statement of cash flows. Yeah, in the 31 March 2008. So there's one thing I want us to do before we go dive into it. I want to share okay? So let us do something beside this place, beside here. So let's just say notes. Okay. Now there is one thing that we can do when we want to start the statement of cash flows that will give us the answer that we are looking for, even before we start the solution. Can you hear me?
Yes, can.
All right, thank you, sir. So there is something we can do before we even reach the final. You know that when we are doing the statement of financial position, whether single or consolidated, if your the total asset did not equal to the total equity and liabilities, then your statement of financial position is not balanced. All right. Though, if it's balanced, it does not mean that it is correct. But at least, if you are in the exam hall and your financial position, whether correct or not correct, but it's balanced, at least you have some degree of confidence that at least you tried, that it's balanced. You are correct. All right. But if it does not balance, even though you've got more than 90% of that question in your solution, you will still be having doubts that this is your financial also. Now, this also will tell us how far that you've gone in your statement of cash flows. So we call it analysis of cash and cash equivalent. Analysis of cash and cash equivalent. All right. So underline. So we now have here to be the closing balance. So the closing balance. Okay. So we underline. Then you bring in all those cash and cash equivalents that you have in your financial position. So which could be cash in hand, cash at bank, then any short-term investment, so we can also have bank overdraft. So this will give us right. So we have an addition here. Then we have opening balance here. Any which way it could be, you can put your opening balance up and closing balance down. It doesn't really make any difference. So opening balance. Then you have all of these again. All right, so what does this mean? So okay. So let's use this Dixon for an example to practice. All right, so that we'll know how far we've gone in this question. So let's very quickly go to right here. We have investments and cash. All right, we have investment as cash. So fixing analysis of cash and cash equivalent. So we have closing balance of 2008. Just of 2008. And here also we have opening balance of 2008. So what is the closing balance of cash in hand of 2008? Please give me figures.
29.
29. 29. For cash at bank, none. Short-term investment,
143.
143. Bank overdraft,
132.
132. Thank you. The total, 'What is the opening balance of 2008? Cash in hand, 117. Thank you. Cash at bank, nothing. Short-term investment,
46.
46. Bank overdraft is what?
54.
54. The total,
54, not 44.
54. I think I wrote 54. Right? So the total
Yes.
is 217. 217. Right? So Okay, so what's the difference? So this bank overdraft is negative figure because it's bank overdraft is debt, right? So 40, then this one is also negative. So we have so we have 109, right? So what does this mean? It means that the cash and cash equivalent in the opening balance of 2008 is 109 naira. But by the end of that year, cash and cash equivalent has reduced to 40. Is that an increase or decrease?
Decrease.
Decrease. So which means we have a decrease of 69 naira. So by the time we are through with our computation, all right, we should be able to have decrease in cash and cash equivalent of 69 naira. Decrease, we should have decrease in cash and cash equivalent of 69 naira. So if you are not getting 69 naira, then which means you are wrong. All right, you are wrong if you are not getting it. All right, so let's now go and look at our listing. So I believe, please, I believe the one that we did now, it's clear. So what we just did now is we just check what would be the answer by the end of our calculation. All right, so, and that is the answer. Okay, so what we now want to do is the statement of cash flows normally. We want to prepare it normally. The one we did was analysis and to check what would be the answer. All right, so I only do that just for us to. Mo máa pè yín padà, ẹ má worry, mo ti rántí bẹ́ẹ̀ yẹn. All right. All right. Sorry for that. So now, let's now start from operating activities. Operating activities. We said that we are starting from, let's look at this. So we have profit before tax, right? So let's start from profit before tax. But we are going for profit before interest and tax, right? So profit before tax. So now profit before tax is how much?
342.
342, 342. Then we want to work back to get our profit before interest and tax, right? So we have, the only thing that we have here as a deduction is finance cost, that there is no finance income, right? So we are going to say that add back finance cost. Finance cost. And how much is that? 15, right? So 15, that's 357. So, okay, finance cost has been deducted. So we have plus 357. All right. All right. So what is the next thing we are going to do according to the format? We go to adjustment for non-cash item. Adjustments for non-cash items. Right. So this will be profit before interest and tax. Profit before interest and tax. Okay. So now, above all things, the easiest one that we can see as non-cash item, we have amortization, right? We have depreciation. Then don't forget that we also have profits on or from disposal of PPE. So our amortization is how much? We have 60,000. So we have 60,000. Then another, we have depreciation of how much? Depreciation of dividend charge in the year on property plant was total 57,000. So we have 57,000. Then we have profit on disposal of PPE. So profit on disposal of PPE, and that is 110 minus 103. 110 minus 103, and that is 7,000. So this profit had been added to that profit. So since it is a non-cash item which was added before, we are going to deduct it. So now we've done that. So please, are you with me? Are we together?
Yes,
Yes.
So we've done that. Now, please, I don't want you to, to get lost. Just follow through as we are going it, step by step. Now, we've done this according to the format. And if you look at this question, it is still very possible that we have some non-cash item that it is not obvious, like the amortization, the depreciation, and profit on disposal of PPE quite well. So if that is the case, what do? We go to this financial statement now. So though what we want to do now is not only that we want to look at, we are looking for non-cash item, but this is the ideal thing for us to do because many things may happen in the ledger. So what we want to do is to look at the ledger one by one and see what has happened in the financial statement. So let's come here. So let's call this working one or note one. So let us now come here. All right. So 2. Look at your PPE. You create a ledger. You know that T format ledger, right? That T format ledger where you withdraw something like this, then you now draw something like this. That T format is what we want to do now. The debit side is there, then the credit side. Sorry, I'm just trying. I believe if you get what I'm saying, just this T format, then you draw your T here. All right, so this side will be debit and this side will be credit. So that is the T format we want to do. But I cannot draw that T here. So I will just put the debit side, then credit side here. All right, that is the two sides, right? So if we are doing our, sorry. So this is Naira. Then Naira for the credit side. All right. So we've done that. Okay, debit side, credit side. Now for PPE, that is how you are going to do for everything, because that is the key point when you are doing statement of cash flows. It enables you to get more points when you are drawing ledger. Do you understand? So you draw ledgers for everything that is drawable, particularly the non-current asset side, the current liability side, to see for any increment or reduction. All right? So for PPE, we say that. So if we want to write the opening balance now for PPE, will the opening balance be on the debit side or on the credit side?
Debit side.
Thank you very much. Really appreciate that. So balance brought forward, debit side. So what is our opening balance for PPE?
737.
737. All right. 737. Very well. So then the closing balance will come here. Balance brought forward, carried down rather, carried down, which is 925. 925. All right. There's no problem. All right. So you can see that there are some things that is missing in between these two things. And don't forget that many things had happened. Don't forget that there is additional acquisition, which was as a result of finance lease. Don't forget that under PPE, there is also disposal of PPE. I don't know whether you are getting me. Even in this PPE, there is depreciation. And in this PPE also, if you look at our revaluation surplus, you will see that something has happened to it. And it was stated, because revaluation is always attributable to PPE asset. So it has been that they revalued that asset. All right. So okay, so we have depreciation of 57. So the first thing that you then need to come, when you are writing, this is ledger, right? So we've come here, all right, so we have what? Depreciation for the year. Depreciation for the year. Which is how much? 57. All right. And again, don't forget that we have disposal. So let's assume that, I want to ask this question now. If there is a disposal in your PPE and you want to pass the entry in your PPE, would it be a debit entry or a credit entry?
A credit entry, sir.
Thank you very much. So we have what? Disposal of PPE. How much is that? 103.
Okay.
103,
Okay.
because that is the book value, right? 103. Okay, so we've done that. Now, is there any other thing that they talk about PPE? Yeah. Yes, they said depreciation charge in the year on property, plant, and equipment total 57,000 naira. They now said Dixon purchased 56,000 naira of property, plant, and equipment by means of what? By means of finance lease. So if there is additional purchase of PPE, would it be a debit or credit entry?
A debit.
A debit.
A debit.
Thank you very much. So what we debit it. So we then have what? Finance lease. Acquisition of PPE on finance lease, which is 56,000 naira. Okay, so that is all well and good. So before we then move forward again, so let me now say number 3 now, note 3. Okay, I'm just kind of weak because I came in from church straighted. I've never sit down, so I just have to take it step by step so that somebody will not just be out. So we have debit and we have what? Credit, right? So we have our naira in thousand. Don't forget that what we are doing is in thousand. So we have in thousand. All right. So we have revaluation surplus. For revaluation surplus now, what is the opening balance figure? For revaluation surplus, what is the opening balance figure?
60.
60. Would it be a debit or credit entry or posting? Would it be a debit or credit posting?
Credit.
Credit. Thank you very much. Please take note that all assets are debit ledger. All equity and liabilities are credit ledger. So which means they are opening an asset will never enter credit closing balance. All right, an asset will never enter credit closing balance. They are always debit balances. They will always have debit balances, while equity and liabilities are always credit balance. So any opening balance in equity and liabilities are always credit side. So in this case, the opening balance of revaluation surplus, as rightly stated, is 60, and as rightly stated, it will be a credit opening balance. So we have what? We have balance brought forward, 60. All right. Then we have what? The closing balance, which is what? Balance carried down, which is how much? Which is 160, right? Okay. So, and we have 100, right? So the 100 revaluation surplus is, I think it was stated somewhere before the assumption. If it is not stated, then we assume that it is as a result of PPE. Then they said once the profit on sale was stated off against other expenses, right? Division charge in the year on PPE, total 50,000. Dixon projects 56,000 naira of property plan and by means of finance leases. Payment being made in arrears on the last day of each accounting period. The current asset investment are going but the new debentures were issued and during the year. And during the year, Dixon made a 148 bonus issue, capitalized it to retain, and is followed by a rights issue. Okay, there's no mention. Okay, yeah, this is where we say it. So this is it. So gain on revaluation of property, plant, and equipment. So the revaluation is attributable to 100 here. All right. So that is where we have revaluation surplus here. So then we have right here, we have PPE 100. Then we balance, which is 160, 160, then 160. All right. So that is what that is for the so the second leg. Don't forget the principle of double entry, that for every debit entry there must be what? A corresponding credit entry. So we now come here. We now have that revaluation sub account, which is what? 100. Okay. So we then look at which side is higher. This is 893 and this is 1085. So this is higher. So we have plus 1085. Then this also. So this will now be this. $893, which is this minus 893. So we have 192. So that difference will now be cash. All right, cash. So this is the cash outflow right here. So this will be what is the reason for, and this side will mean that increase in PPE, which is outflow under investing activities. All right, so no problem. We'll get there. So we've done that. We've done that. So we are just trying to look for if there is anything that we need to take note here. So let's just move on gradually. So number 3 now. So we then also come here. We have development expenditure. Development expenditure. Development expenditure. So we have so don't forget that this is an asset. So we will be coming here. Okay. And our balance carried down will also come there. So which is the balance brought for development is how much? 160, right? So what is the closing balance of development expenditure?
290.
290. All right. There is no additional information on development expenditure, or is there? Is there additional information on development expenditure?
No.
Are you sure? Do you have the material?
Yes, we have.
Okay. What does this
During
mean?
2008, amortization of 60,000 was charged on development projects.
Thank you very much. So that amortization, will it be a credit or debit entry?
Credit entry.
Credit entry. Thank you very much. So which means whatever reduced the value of our assets will be on the credit side. Whatever that increases our assets will be on the debit side. Don't forget the usual language. Debit the account, the usual principle for ledger. Debit the account that receives and credit the account that gives. All right. So which means if something is moving out of our development expenditure or any asset, we are crediting it. If anything is coming into our asset, we are what? We are debiting it. So we have amortization, which is 60, right? Which is 60. So this definitely totals 350. Okay, that's 350. So the difference between 350 and 160 is how much? Will be cash. That is 190. All right. Don't forget that we are only trying to look at the ledger to see if there is any other thing that we need to incorporate to that thing that would have passed through our operating activities. All right. So we've reached current assets. Current assets is a different ballgame entirely. All right. So inventories, trade receivables will form part of our changes in working capital, increase or decrease in working capital. So we don't really have issues with that. So we are going to treat that when we get there, All right. So we have total asset now, which is equity, share capital, and the likes. All right. So let me just pause here. There is nothing else. So I will continue that issue of ledger. So let me just continue from here. So we've reached our profit on disposal. So there's none other thing that is required right here. So the total that we have is 110. Okay. So let's also move on to changes or increase or decrease in working capital. So increase or decrease in working capital. Fine. So we'll now go and look at what is our working capital. We have inventories. Then we have trade receivables. Then we have trade payables. Trade payables. Quite all right. So we want to check whether there is increase or decrease. So inventories, at the beginning of 2008, we have 227 as our opening balance. And at the end of 2008, we have 360 naira as our closing balance. Are we going to say it is increase or decrease in cash?
It's an increase.
Is what?
Increase.
Increase.
Yes.
Thank you very much. It is an increase in value. But let's assume that we have 227 worth of goods in our stock. All right? 227 worth of goods in our stock. Okay, let's say yesterday, we have 227 yesterday. And today, we have 360. What does it mean? What does it mean? Ma'am, what does it mean?
Increase in inventory.
Increase in inventory.
Okay.
All right. So what does it mean to cash? Madam Kuburat, you want to say something?
Cash will reduce.
Our cash should reduce. Now, this is it. Our focus is not assets. It's not liabilities. Our focus in cash flow statement is the cash. If our inventory was 227 yesterday in value, and today it has increased to 360 naira today, it means that somebody has gone to the market and buy additional inventory. So which means we've parted away with cash. I don't know whether you're getting me. So if we've parted away with cash, it means that our cash that we have has
Has
reduced.
reduced.
You understand me? So that means any increase in cash is a reduction in, any increase in inventory is a reduction in cash, and any reduction in inventory is an increase in cash. If yesterday we have 400 naira worth of inventory, and today we have 100, it means out of that 400, we've sold 300 inventory and we've received cash for it. It means that our inventory has increased. Our cash has increased. Are you with me? And inventory has reduced. Do you understand me? So please take note of that. Please take note of that little assertion. It is very important. All right. And that is what we will be doing. So 360 naira minus 227 naira. What do we have?
One 133.
133. Negative or positive?
It will be negative.
Negative 133. Right? Another test again here. Another test again here. Our trade receivables opening balance is 324. And trade receivables in closing balance is 274. Opening is 324 and closing is 324 and closing is 274. So is that increase in cash or decrease in cash?
Increase in cash.
Increase in cash. Please explain.
As at opening, we have 324, which shows, and the closing is 274, which shows that we have received more money from what we sold out.
Okay.
So we have a closing of 274.
Thank you very much. Thank you. So which means trade receivables are those people that we sold goods to on credit. So at the beginning, we expect them to pay us 324. By the end of the year, that figure has reduced, which means they've paid part of 324. So what do we have as figure? What do we have as figure? Figure.
50.
50, positive or negative?
Positive.
Positive. Thank you very much for that. So trade payables now, what do we have under trade payables? The opening is 352 and the closing is 274. So is it an increase or decrease?
It's a decrease.
It's
Yes.
an increase. Okay. Can you explain that as well?
Okay. Our payables was 352 opening, and we're able to settle our debt, and the reduction is 274 for the closing. So I think it's a decrease.
Is a decrease. Okay, thank you. So thank you very much for that. So at the beginning, we were owing 352 to our suppliers, but we've reduced that that figure to 274. So which means it means that we've parted away with what? With cash, right? With cash. So which means we have decrease in cash. So what is the figure?
78.
78. So which means, is it positive or negative?
Positive.
Negative.
It should be negative. So
Negative.
yeah.
Negative.
Is it, you said 70 what?
78.
78. All right. So according to the format that you have, we have taxation paid and interest paid. All right. So taxation paid. So we go and create a ledger. So this is number 4, taxation account. So we have so the opening balance, the credit side, then we have what? Balance brought forward. All right, so you go to the place where you have tax. All the taxes that we have current tax and we have deferred tax. We have current tax and we have deferred tax. All right. So what is the opening balance for our current tax?
153.
153. What of deferred tax?
45.
45. The same also goes for our balance carried down. So what is the closing balance for our current tax?
56.
56. Deferred tax?
48.
48. All right. So everything seems fine. Then you then go and look at another place where they mention tax again, which is the profit or loss. So because we paid, we recognized a tax during that year, during that period. So we have income tax expense, which is 162 naira. So P or L. P or L. $162 naira, which means that we have the total sum of 360. And this place we have 104. So the difference right here would be 360 minus 104, which is 250. So this is what cash paid. So this is 360. Okay, so we have 256 as our cash paid. 256. So that is payment, right, which is negative. Okay, so we have again interest paid. Interest account. So it is very possible that we don't have any interest from our statement of financial position. But if we don't have, if we don't have, then the one that is paid in the statement of financial position will be the final, which is 15 naira. All right, 15 naira. But if there is, then we are going to do the usual thing, balance brought forward and balance carried down. So we go to the current liabilities. So we have debenture interest. All right, we have what? We have debenture interest. So the debenture interest, we have 5 naira, the closing balance, and 0 naira in the opening balance. So balance brought forward, we have what? We have 0, right? So then balance carried down. We have how much? 5 naira, right? Yeah. So then in between, we have P or L. So don't forget. Now, the reason why one thing I just for P or L is that your P or L will be under the balance brought forward. All right. So if it is an asset, all right, and you want to bring in anything, all right, from P or L, you will put it under your balance brought forward. So P or L, we have 10 naira here. All right. Then you have balance carried down 5. So the difference, so we have 10 naira here. Or your POL is 15. 15. I guess 15. 15. Yeah. So this place we have 15. 15. Then cash paid we have 10. So then we come here. Interest paid is 10. All right. So in our format for operating activities, that is the end. So we have a total sum of 427. Okay. The total sum we have here is this. Let me just, the total here is 40. 40. Okay, so this will be net cash flow. Net cash flow from operating activities. Net cash flow from operating activities. All right. So we move to what? Investing activities. Investing activities. Right? So for investing activities, we have PPE. So we have two things that we need to place our focus on, our eyes on. So we have property, plant, and equipment, and we have what? Development expenditure. So don't forget that for property, plant, and equipment, we already have the ledger. So, and for development expenditure. So very quickly, for the ledger will tell us the hidden thing. So this is the PPE. So we have on the debit side, we have a cash of 192. And don't forget that means there's increase in PPE. There is what? Increase in PPE. So once there is increase in PPE, that means there is what? Acquisition of PPE. We have acquisition of PPE. That is 100. So that acquisition of PPE, is it a cash inflow or cash outflow?
Cash out.
Cash outflow.
Cash outflow. Thank you very much. So we have what? 192. So another thing that we have is PPE and development expenditure. You can see that there is increase in development expenditure as well. So which is 160 to 290. So let's look at the ledger because we have amortization also. So the cash is what? 190. All right. And that is what? That is 190. That is increase in development expenditure. All right. So that increase in development also means what? Additional acquisition of what? Of development expenditure. All right. So we have 180. Don't forget that these are costs. These are costs as well. So don't also forget that in the question, we saw 110 disposal of PPE. So don't forget that this will be proceeds from disposal of PPE. Which is what? Which is 110. All right. So the major point that I want to note is that our investing activities is from this place. All right. So it's from that side of the financial statement. Okay. So
Hello, sir.
I'm with you, sir. I'm with you now.
Okay, the second line is still carrying acquisition of PPE, which is supposed to be development expenditure.
Thank you very much.
Okay, and I also have a question.
Please go ahead.
Okay, on this, the current assets, there's a figure for investment there. Is it supposed to be under investing activities?
Okay, is that Madam Esther?
No, blessing, sir.
Okay. So now, if you go and look at, number one thing is this. If it is investing, it has to be a long term, more than 1 year. So before any item will be qualified as investing activities, it should be longer than 1 year. Are you with me?
Yes, sir.
Just like non-current assets. Non-current assets are tangible assets, are assets that we invest in for more than 1 year, 2 years, 3 years, 4 years, right? So that is the attribute for investing. You cannot say that you invest for 2 months, 3 months, and you say you want to categorize that as investing activities. However, we have some investments that are short-term in nature. So investments like this, under current asset, don't forget that current assets are short-term assets. So this investment is categorized under current assets. So it is a short term. So it's not categorized under non-current, which means it is not investing. Additionally, if you look at the question in additional note 3, this place that I just highlighted, all right, you see they said the current assets, investments are government bonds, and management has decided to classify them as cash equivalents. So which means it is readily available in form of cash anytime they need it. So it is categorized as cash and cash equivalents. Have I answered your question?
Yes, sir. Yes, sir.
Thank you very much. So that is so we have this. So you don't have to stress yourself under investing. You go to where it is. You don't have to stretch yourself under financing. Go to where it is. All right. Basically, the format will tell you where those things are. So we can just call this net cash flow from investing activities. All right. So this will be 232 negative. So you can say that this is net cash flow before financing activities. All right. Then we go to financing activities. All right. Okay. Don't forget that financing activities have something to do with the method of financing, either in form of equity or long-term debt. All right, either in form of what? In form of equity or long-term debt. All right? All right. So let us quickly dive into it. So we can just draw out the ledger for the equity and liabilities. So we have this as our 5. We have this as our 6. So we have equity, share capital. All right, so we have debit and credit. Okay. So we have balance brought forward for share capital is 400. Then we have balance carried down to be how much?
500.
500. So the only thing that can increase as our cash here, not only thing anyway, but because we can have capitalization of our retained earnings, there can be bonus share issue, there can be new share issue, and all of that, right? But one of where we can get our answers is they said during the year, Dixie made a 1 for 8 bonus issue, capitalizing its retained earnings. So which means we want to give out shares to our shareholders, but in form of bonus. So which is they are not paying any dime for it. And if they are not paying any dime for it, it means that we want to give them for free. All right, so we have share premium. We have share premium. So before we do that, because there is also increase in share premium, of between 100 to 350 naira. So which means there is also new issue of shares. There is also new issue of shares, right? So very quickly, let's just calculate the bonus issue. So we've been told that share capital is 1 naira ordinary shares. So which means at the opening, we have 400,000 number of ordinary shares. All right, so let me just put it here, 7. So we have bonus issue. So for the bonus issue, they said 1 for 8. So you'll be getting 1 for 8 that you have in 400,000. You'll be getting 1 for every 8 number of shares that you have in the 400,000. So which means multiply by 400,000, 1, 2, 1, 2, 3, divided by 8. So we have what? 50,000. All right. So we have what? 50,000. So 50,000. All right. So which means we will have to come in. So I just want to, I don't want anything to affect this share capital, share premium. Then we have retained earnings. So let me just bring the retained earnings here. Retained earnings, because they all go together in this question. So we have this, then this. So what is the share premium opening balance?
100.
100. Thank you. 100. So we have, what is the balance carried down?
350.
350. Balance carried down. 350. 350. So the retained earnings opening balance?
255.
255. Then the closing balance is
229.
229. 229. 229. 229. Okay. Okay. So now, these things, all of them have their own peculiarity. All right. All of these ledgers, they have their own peculiarities. So if you look at the retained earnings, for instance, you will see that retained earnings are from profit or loss, right? So if you come here, you will see that we have a profit of 180 naira. Am I right? So that
Yes.
180 naira will now be added to that 255, because it will be coming to this place. So this would be profit for the year. Profit for the year. So we have what? We have 180. So that is what increased our retained earnings for that year. All right. So, but now you will also see that the question said that they capitalized their retained earnings by the bonus issue. So, which means they removed from retained earnings to get the bonus issue. So, we have the bonus issue, which reduced our retained earnings bonus issue now. So, the bonus issue is 50 as computed. All right. So now this bonus issue, I just write this bonus issue. What it is, the ledger that is affected. So it affected with debit retained earnings with which is ordinary shares. Ordinary shares. All right. So we now credit our ordinary shares. Debit the account that gives in this case now, because it is retained earnings, credits. So we have what balance brought forward. We now have bonus issue, so which is from retained earnings. Retained earnings. So we have what? Bonus issue. So which is what? Which is 50. All right. So we've done justice to that, right? So There is none other additional information to this. No mention of share premium, no mention of the amount of the premium. So we've done this. So let's look at the balancing figure now. The balancing figure right here, we are having 435, 435, 435. Then we have the balance here to be 279. So we have 439, 439, and 4. So let me just put it here. 439, 439 minus 279, 279. So we have 160. So this 160.
Excuse me, sir. I think it's 435, not 439.
435. Okay. Thank you. Five, 435. So we have this 156. So we have the total sum here to be 435. So the share premium here as well, we have, so there is no mention of share premium and there is no mention of the new issue. So we just assume that the difference between this place, which we have 500, 500, and the difference of 500 here, which is 50, 500, will be our new issue of shares, issue of shares. And the share premium, we have 350. So, and this is 350. So we have 250, 250, then we have cash from the issue of shares, the share premium. Then this also will be cash. So it should be 50. So that is what we want to go and incorporate to this place. So we have, sorry, proceeds from right issue. Or issue of shares. So where we have 50, 50 plus 50 plus 250, 50 plus 250, +50, which is 300. So that 50 and 250 is from our ordinary share ledger and share premium. All right. Then we have so what else do we have from this calculation? So share capital 50, 50. So then we have this cash. Okay, retained earnings also, we have this cash. So this cash will now be dividend paid, which is the difference, dividend Dividend paid. Dividend paid, 156. Dividend paid. $156. So then that aspect that we just worked on is the aspect of equity. Then the next aspect we have to look at is liabilities, long-term liabilities, which is 6% debentures and finance lease liabilities. All right. So we come here. So we come down here, we say that 8. So this is 6% debentures, debenture. All right, then we have the balance brought forward, which is how much? 100. Then we have the closing balance, which is balance carried down, to be 150. All right, 150. Now we go and look at additional information. They said the new debentures were issued on 1st of April 2007. Finance costs include debenture interest and finance. So that is the only additional information, and we've treated that already. So there's non-additional information relating to debenture again. So we have what we have: cash received from the new issue of shares. Cash received from new issue of shares is 150. Right? So we have 50. So we have 50. So because we received this new issue, so we can say, we can call this debentures raised. So we then go to this other ledger on that long-term liabilities. Which is finance lease of liabilities. Finance lease liabilities. So under finance lease liabilities, we have the opening balance. What is the opening balance under finance liabilities?
80.
80. So this 80 is the one under non-current liabilities. Then we have the one under current liabilities, which is due in that year. So we have what? We have 12. Then we have balance carried down. So our balance carried down, we have non-current liabilities. How much is that? 100, right? Then current liabilities, we have what? We have 17. We have 17. All right. So that is for the opening balance and the closing balance. All right. So the next thing for us to do is that these finance lease obligations, what is the additional information that we have under it? So we have additional information. Additional information 2. the last sentence, they said Dixon purchased 56,000 naira of property, plant, and equipment by means of finance leases, payments being made in arrears on the last day of each accounting period. So that is what? That is the finance lease. So we have increase in finance lease, which is PPE. This is the second leg of that PPE, which is 56. Don't forget that we debited that account, PPE. Now this is second leg. So we have the additional information to be 148. Then this is 117. So we have so 148 minus 117. So the balancing figure so we have so what we have here is the cash paid from any question? Capital sum on finance lease. You want to say something? 31. We have capital sum paid on finance lease obligation, which is 31. So that is everything that we have under the liabilities. So we have net cash flow from financing activities. So we have so then we come here. Okay, so this plus this, so we have 69. So this is decrease in cash and cash equivalent. Decrease in cash and cash equivalents. So which is 69 that we have here. All right. So for us to balance it up, we now say balance brought forward. So the balance brought forward in the beginning is 109. So this is balance underline. So then we have balance carried down. So 109 minus, that is 40. So Do you have any question from this little question that we've played with?
So I want to take you back small on that
There is,
interest page.
there is no problem. Let's go ahead.
On that interest page, how
Interest
do we
page.
get there?
How we got to
10.
how we got 10. Okay. It is from the ledger. Let me just, this is interest account. All right. So what we do is that if you go to the profit or loss, you will see that we have finance cost, and that finance cost is 15. All right. So when you go to your ledger, your financial position, you will see that we have debenture interest, because additional information had mentioned that the new debentures were issued on 1st of April 2007. I'm reading the additional information for. It now said the finance cost includes debenture interest and finance lease finance charges only. Okay, so we'll just come here. The only interest that is paid in the statement of that is given in the financial position is debenture interest 5. Can you see it? So for the
Yes, I can.
okay, so for the interest account, we have 0 opening balance. So we come here, 0 opening balance. This is it. All right. Then we come, the closing balance is 5. All right, the rate of interest 5 under the financial position. We do that. Then the P or L, which is 15, all right, will be on the credit side. P or L on the credit side, which is under balance brought forward right here. So we sum it up and we balance it. So the difference between the 15 and 5 is the cash paid. All right, is the cash paid, which is 10.
Okay, sir.
That is how we. Okay, so cash paid is a balancing figure. So is there any other question?
Yes, I have a question.
Please go ahead.
Okay. From my previous knowledge of cash flow,
All right.
I was thinking our closing cash on the cash flow after the financing activity is supposed to give us the closing balance of cash on the statement of financial position, which is 29.
Okay, let's go there. Okay, I've seen it. Okay. You mean this one, right?
Yes.
It's all right. Well, like you mentioned, you said from your previous knowledge, and this is your new knowledge. So, and I want to tell you that when we are doing cash flow statement, what we are doing is we are looking at the closing balance of cash and cash equivalent, not this cash we're looking at. So it is very possible that in the question that you are creating, can you hear me?
Yes, I can, sir.
So it is very possible that in the question you are treating, what you have in your financial position is only cash, and there is nothing like cash equivalent. Are you there? So because when you look at this question, we have equivalent of cash, which is investment. All right. So in this question, it is a different ball game entirely. So I think, let me check this question. Let me check this other questions that would have, like this mocha question. Aha. If you look at this question now, we have current assets, inventory, trade receivables, and bank. And let me see whether we have bank overdraft. So we have bank overdraft in this question. All right. So in this question now, we have bank overdraft. All right. So for bank, we have 3.5, and for bank overdraft, we have 2,900. So in the questions where you have bank overdraft, I am just trying to picture something for you now. So let me ask you this question. In this question, what are the cash and cash equivalents that we have? You can see it from your current assets and from your current liabilities.
We have the bank.
Okay.
We have the bank overdraft.
Okay.
We have the provision for product guarantee.
Provision. No. Provision is not cash. It is provision. It is non-cash item. Do you understand?
Okay.
So now, so the two cash and cash equivalent that we have in this question is bank and bank overdraft. All right. So now let's look at it together from your knowledge now. All right. What would be the closing balance from your knowledge, from your word? What will be the closing balance of, if we do it your way, it will be what? Bank nil, right?
Bank is not new. Bank is okay. I can see it now. It will be bank new. The closing balance would have been the bank overdraft of 2,900.
Thank you very much. It would have been what? 2,900. Do you understand? Now let's assume now that we have short-term investment in the question. Do you understand what I'm saying? So let's now assume that we have short-term investment. The answer would not have been only bank overdraft.
Yes.
You understand? So we have to do the analysis first. So because once you are incorporating the analysis, so if you look at this analysis now, we have cash in hand, we have cash at bank, we have short-term investment, and we have bank overdraft to be cash and cash equivalent. So in this question, we don't have cash at bank. All right, we don't have cash at bank, but we have short-term investment. And the question had actually mentioned that we have to incorporate short-term investment as our cash equivalent. Do you understand? So now that we have cash in hand, we added it together in the closing balance, and we remove the bank overdraft for the closing balance, which gives us 40. Do you understand me? Now we have
Yes,
opening
I get the analysis.
So we opening balance, we have 117, and we have short-term investment 46. Then we remove the bank overdraft, which gives us this. So we have the balance brought forward of the closing balance of 40, and we have balance brought forward of 109. Do you understand? So in the beginning, we have 109 as our cash in assumption. Let's even forget about short-term investment now. So opening balance, we have 109. All right. So which is cash. I'm just saying cash. Let's forget about cash at bank, short-term investment, bank overdraft. So the closing balance is 109. The opening balance is 109. The closing balance is 40. Then from this analysis, so which means there is a reduction in 40. So before we conclude which would be the last, it's not about cash. It's about what are the cash and the cash equivalents in this question. So we now incorporate everything together before we get the cash and cash equivalent. Do you understand me?
Yes, I understand, sir. So is it possible for this video to be dropped today so I can go over it today again?
It is very possible. It is very possible. Can you see my screen?
Yes, I can.
All right. It is possible. It is possible. All right. We still have, my battery still have 3 hours, 7 minutes. So I will wait till it got converted. Then once it's converted, then I will share it with you.
Okay, thank you so much, sir.
You're welcome. All right. Is there any
And this Excel sheet to help us share it too.
Excel sheet? Okay, very well. I will do that. Okay, let me just share the Excel sheet now. So I will leave you to the Mocha question. All right, I will leave you because Mocha question is also just one question, which is also related to single cash flow. So our next class, we go to consolidated statement of cash flows. All right, so if you are here on Sunday.
Hello, sorry, sir. My concern about this, your questions,
Okay.
even when we attempt it, there's
Okay.
no way to even check if we are correct. Like, there are no answers. If maybe there is a past question now, we can easily say, okay, I've tried this thing, let me check the solution in past questions and see whether
You are
I'm
right.
on the right track. Because
Okay.
I know I've tried something like that. I even sent it to you. You didn't even respond to it.
Are you serious? Okay, do me a favor.
Yes, there was a time I solved a question.
Okay, I'm sorry for that. All right, I am sincerely sorry. Apologies. Now, just send me I, because it is very possible probably you did not send it to me. Probably you've sent it to me. So I'm not. So just send me I now. So I will check your message and I will reply. Now, this is it. Of course, when you are solving questions, Pathfinder, you will see solution, all right? You will see how they treat it and all of that. While that is partly, very well, very good, you cannot have all answers to all questions. Because when you get to the exam, all right, if you've not treated that question before, you have to treat it to the best of your knowledge. Do you understand what I'm saying? So the questions that you have, if you solve this question and you ask me for solution, if you get it, definitely I will message you back. I will reply that, okay, this solution is fine. But I have not, so apologies, please send it again. Solve questions. Don't say because I don't reply. I have never seen it before. If I had seen it, I would definitely reply. Do you understand? So send this one to me again. Just send me hi. I will reply to you immediately. Do you understand? So please solve
Right, sir.
it. Don't just, please solve it. Do you understand? All right. So, and, of course, I promise that I'll reply to you. I'll reply to your questions. Thank you very much for that.
Thank you, sir.
Thank you, sir.
Thank you very much. So I've sent this one, so I will share it with the financial reporting tool. So I will make sure once this one got converted, I will send the one for yesterday and today. All right. So, all right. I have seen your message now. Thank you very much, and enjoy the rest of the day.